towards the title, that essentially covers where I think we're at in the market right now. We've entered a somewhat unusual period in the market where we're in what I would call the late stages of the cycle. Normally, late stage economic cycles is actually the best time to be in commodities in general, metals specifically. There's several reasons for that. But normally, when you get into the late part of the cycle, that's when you first start seeing supply push, where supply constraints start evidencing themselves. You start seeing price increases. Theoretically, at least, I don't think we've seen that much of it. Although there was certainly some evidence in the last U.S. payroll report that we're maybe finally starting to see wage gains as well. You get those late in the cycle, and usually the combination of wage push and supply constraints, you start seeing some inflation moves. And generally speaking, the best part of the cycle for commodities is the late part, because as you get to those supply constraints, you start seeing prices move higher. As you get a little bit of inflation movement, you generally get central banks, at least for some period, behind the curve, which is to say they're not moving yields as fast as inflation's moving. You tend to get a switch from positive to negative real interest rates, and that historically has been the best environment for commodities during any part of the cycle. This is a very long-term chart, and what this chart is this is basically the producer price index going back about 70 years. You'll notice the gray bars, those are recessions, and you can see towards the end of these cycles, you get this move up. And this, keep in mind, this is a very long-term chart, so these peaks are muted, but they're a lot bigger if you're looking at them close up. You do get the big moves in producer prices, which is to say big moves in commodity right towards the end of the cycle, right before things roll over. And when I say right before, I don't mean the last 3 months. I mean like the last 2 or 3 years generally in the cycle is where you get most of these price moves. And that's sort of the optimum time to be looking at these sort of equities. We are late cycle. These are current charts. You can see the chart on the left, which is that's the ISM input prices, and that's essentially an equivalent to the producer price index. This is prices paid by various industrial companies for things they're buying. It's a good early gauge of inflation normally. You can see it's been on an uptrend. It's not what I'd call a strong uptrend, but the uptrend is definitely there and a lot more obvious now than it was even a few months ago. On the other hand, if you look on the right chart, which is the core PCE, basically the consumer level inflation, there's been an uptick in the last few months, but it's definitely nothing to write home about. I'm not quite at the point yet where I'm not a gold bug and I'm not an inflation hawk. So although I'd like to see a bit more inflation, I'm not completely sold on the idea that we've got it yet. I'm actually waiting to see the next U.S. payroll report. I think the big jump we saw in wages last month that got everybody so freaked out, I think some of that was statistical, not actual. I got a feeling we're going to see that get corrected down during the next payroll report. So, but I do think we are on the leading edge. But it's that CPI, PPI. It's the consumer one that we really want to see moving. The PCE deflator, which is a variation on the chart on the right, that's the one that the Fed uses. That's their inflation watch. So they are starting to watch it closely, but I don't think we're at the point yet where we certainly need to worry about it yet. The other thing you get late cycle, commonly, you've had a very long bull market. People tend to get more and more bullish as time goes on. You tend to see more money moving into more speculative parts of the market. I think probably the primary primo example lately has been Bitcoin and other cryptocurrencies. But you also tend to see large moves in real estate, collectibles, art. We've seen all of that. I mean, you're seeing record prices for all of that stuff. It's basically, you basically get to the point of excess bullishness. This chart I find interesting. This is a very long-term chart. It's generated every month by the Investors Intelligence, and it's a survey they do every month of whether retail investors essentially are bullish or bearish. If you look at the top chart, The top chart's really just a summation of the bottom chart, and that's basically people that are bullish subtracted from the percentage of people that are bearish. And what I find interesting with this chart, because it's quite current, you see how extreme that got. Like, that's a very long-term chart, and the level of bullishness was very, very extreme a month ago. But this chart is actually a current one, and if you look at the current reading, yeah, it fell off a bunch in the last couple of weeks, but it's still extremely strong historically. So anybody that thinks the sort of conniptions we've had over the last 2 or 3 weeks has spooked everybody and that we're no longer in a bullish phase, think again. I mean, that really didn't reset things that much. It's still pretty crazy out there. Now, what's different about this cycle? I mean, I don't want to lean too hard on all the comparisons because it has been a very weird cycle in a lot of ways. And a lot of that is due to the extreme depth of the last recession and the moves that various central banks and governments have undertaken since. You know, because of the amount of liquidity that's been pumped into the system worldwide over the last few years by central banks, we haven't yet seen what I would consider normal moves in yields. By this part of the cycle, I would have expected yields generally to be higher, but they've been suppressed by central banks the whole way through. The other thing we really haven't seen, really for an 8 or 9 year expansion, we haven't so far seen what I would call general wage increases. Most of the gains this cycle have been pretty concentrated in the top few percent income-wise. It hasn't been very even at all. That's one of the reasons I've been a bit of a cynic about it really up to now, and why I'm waiting to see evidence in not just supervisory wages, but basically, you know, your average guy or average woman getting these wage gains that keep getting promised by governments. We'll see if they come, but it's been very uneven, so it's made this an unusual cycle in that we really haven't until now seen very much movement in the yields. That's helped actually increase the amount of speculation because because yields haven't been there in terms of paying up. So the bond market has been rising almost continuously through this cycle at the same time as equities have. The question is, when does all this roll over, and how much is this going to change this year? I think we're starting to see change now. We're finally seeing those yields move. The chart on the right there, that's the US 10-year yield chart. It's a pretty dramatic move in terms of what's happened over the last few years, although it's still not a very big move by historic standards at all. But as you can see, that move, once we get up to 2.8, 2.9 in the 10-year, started freaking out equity traders. We had that correction last month. Things are still pretty uneven and a little bit spooked even now. The question, and it's sort of the $64 billion question in the market right now, is what level of yields is going to really roll things over. I don't think, nobody really knows. A month ago, guys are saying 3%. I don't think it's that low personally. I think yields would have to move farther than that for equity traders to get well and truly freaked out. But there's no doubt about it that I think the days of low volatility and markets going straight up that we had for 18 months there are over. I think what we've seen on this chart on the left, that's the S&P chart. You can see how much movement we had. I think that's pretty much what we've got to look forward to for the next couple of years, which I'm fine with. I mean, I found the exceedingly low volatility over the last 2 months was actually starting, last 2 years was actually starting to spook me quite a bit. As my readers know, the issue that came out right before that dip, I was telling people there was a correction coming very, very, very soon because things had gotten so one-sided that there was no way the market could hold itself together. It wasn't going to take much to spook it. The other issue we've got, of course, is we've got an extremely unpredictable White House, to put it politely. That's also going to add a lot of volatility. You just never know what the guy's going to do from one day to the next. I think the kind of thing that we saw on Thursday and Friday where he got up that morning and decided to impose steel and tariffs, we'll probably see more of that sort of stuff. I think right now we just have to accept the fact we're going to see more volatility. That's the bad side of it. The good side is we are getting in that late part of the cycle. I'm fairly comfortable that at some point here in the next year or so, we will probably see real yields go negative. That's the optimum environment for precious metals, commodities in general, and resource stocks. And what do we do in the meantime? I mean, essentially, I think we have to stick to what's worked for the last few years, going through the bear market and now into this bull market. There are a couple of types of situations that I think work in this situation and can help you deal with an overall volatile market. And those two types of stories, not surprisingly, are represented at this table, which of course is not a coincidence because these are all companies I invited. There's basically two types of companies that you're about to hear presentations from. Broadly speaking, one is high impact exploration stories. I like looking at companies where they have strong technical management, where you've got technical management that's got some imagination, that's willing to go apply models to new areas or apply new models to known areas and come up with targets that have scale potential, ideally targets where a relatively small number of drill holes, not one or two, but a relatively small number of drill holes tell you whether you're right or wrong. That's the type of situation where if the exploration program works out, you've got very high leverage to discovery. So those are the kind of stories that can move a long way quickly if things work. You know, they're higher risk, but I mean, that's what you're here for. These are none of these are widow and orphan stocks. And I think if you're trading these kind of stocks, I think you want to be trading discovery stocks, not just more developed ones. And the other one, you know, the other broad group, I guess I would call it, and which is also represented here, is, and I've got basically a gold one, a silver one, and a copper one, and that is companies that have lowest quartile cost production capability. These are developers that are working on projects that when they go into production should be the bottom quartile of the cost curve. In the mining business, or any other business for that matter, that's really where you want to be. That's sort of the safe space, if you will. Those are the mines that manage to survive through up and down cycles. And not coincidentally, operations like that, although quite often the high margin operations tend to be a little bit smaller. It's just the nature of how the business works. But they also tend to have lower capital intensity, which essentially means less money up front for each pound or ounce of production, which tends to make them more financeable. And that gives the company that's developing it the option of developing itself, but just as importantly, the option of looking a potential acquirer in the eyes and saying, we don't need you, we can do this without you, which is really where you want to be if you're a developer. Even if what you really want is to be taken over, you don't want the market to be assuming you have to be taken over for the mine to be developed. You want that takeover to be the bonus. And you know, thirdly, these lowest quartile ones, not surprisingly, they tend to be the first ones that are the takeover targets when you go into these M&A periods. We haven't been in one for a little while. There was a bunch of M&A going into 2016, early 2017, and things flattened out again. But I think as we go back into this cycle through this year, I think we'll see another wave of M&A activity, and I think the lowest quartile producers are the ones that will be going after first. I'm going to give you a super fast overview of each one of these guys as I introduce them. Because we've got such a full schedule today, I'm actually going to try to use Jay's inability to catch a plane or inability to find a plane that would fly to shorten the schedule a little bit. So I'm going to talk about metals a little bit after lunch in Jay's part of the thing, but I'm going to move now to introducing the first speaker.